Hello, everyone. This is Bob Lowe, CSIA Executive Director. Thank you for attending the May CSIA webinar. Today's webinar will provide you with an understanding of ownership transition using ESOPs, Employee Stock Option Plans. This mostly applies to U.S. firms, but may have applicability outside of the U.S. The host and sponsor of our monthly webinars is Software Toolbox, a CSIA partner member. Software Toolbox helps systems integration companies lower their risk on projects that involve software by providing them a unique mix of off-the-shelf software products and rapid response technical support that minimizes the need for custom code and lowers field startup time risk. I would like to introduce today's webinar presenter, Corey Rosen, Ph.D. Corey is the co-founder and senior staff member of the NCEO, which is National Center for Employee Ownership. Rosen received his Ph.D. in political science from Cornell University in 1973, after which he taught politics at Ripon College in Wisconsin before working on Capitol Hill for the next 5 years, where he helped initiate and draft legislation on ESOPs. In 1981, he formed the NCEO. Over the years, he has written, edited, or contributed to dozens of books, articles, and research papers on employee ownership. He is generally regarded as the leading expert on employee ownership in the world. So, without further delay, here's Corey.
Thank you very much. I really appreciate the opportunity to do this. And again, my name's Corey Rosen, and I'm with the National Center for Employee Ownership. And before assuming that I know what it is that you're hoping to find out here, there are some poll questions here. And you can see those there, and Bob's going to give me the response to those.
Yeah, I'll actually handle that, Corey, and let you know that people are responding now.
All right.
Poll will be open for about another minute and a half, folks. Like so far, Corey, everybody who's answered is a closely held business. A lion's share of them are looking at employee ownership for transition.
Good.
And they're looking at it for a few key people.
All right, excellent.
So,
well, since that's what we're going to be talking about, I'm glad that's what people are interested in.
Yeah. Give it another 30 seconds here, and then we can continue on. But I'm not seeing a significant change in the results. Just have a couple that aren't looking at it for transition and aren't looking at it for a couple key employees.
Okay.
Rest are what you expected. Okay?
Sounds
All righty.
good.
You want to go ahead?
Let's go ahead.
All righty. You can roll ahead, Corey.
Okay. Actually, I'm not seeing my slides on the screen now.
I just closed the poll.
Okay.
And you are the presenter, so you should be good to go. Just click on your slide tab, please.
I'm still seeing the CSIA webinar here.
Okay. Click on the tab. You should have 3 tabs at the top of your slides. If you could please click on the one that says CSIA. Those are your slides.
I'm not. Yeah, I'm just getting.
Click on. You should have another one other tab that says CSI and nothing else on it. That's your slide deck. There's 3 slide decks up there: our opening, our closing, and yours.
Well, I'm clicking on that. It says CSIA opening and CSI. Oh, I see. Okay, there we go. All right. Sorry for the confusion there. And again, my name is Corey Rosen with the National Center for Employee Ownership. We are a private, nonprofit, membership-based information organization, and we're in Oakland, California, but we operate nationally. We're not a lobbying group. We're not a trade association. We do rely on our memberships to support ourselves, but we also are not primarily a consulting organization. Our role in life is to provide objective, reliable information about broad-based employee ownership plans. And today I'm going to speak about a very specific kind of employee ownership plan, but I'd be happy to answer questions about other ways to use employee ownership for business transition or just to provide equity to key employees. And what we're going to talk about here is the ESOP, and that stands for Employee Stock Ownership Plan. Now, it's easy to get this confused with employee stock option plans. Option plans are something very different, and of course in the technology sector there's something very familiar, where you give employees the right to buy shares at a price fixed today for some number of years into the future. So if you're a Facebook employee, you are delighted with the idea that your company gave everybody stock options. They're going to be worth a huge amount of money. But an employee stock ownership plan is something completely different, and we will explain what that is. But they are a particularly favored vehicle for business transition. In fact, Congress specifically created laws to make ESOPs the most favored way to provide for business transition. So they were started in 1974, started in the sense that Congress provided a legal statutory framework. In 2010, they'd grown to about 11,000 companies with 12.7 million employees and $900 billion in assets. In other words, these plans are a significant part of the economy. They're not some oddball rarity. They are most often used for succession planning, which will be our focus today, but they can also be used to finance growth, to reward employees, to match 401k deferrals, and they have very significant tax benefits all around for selling shareholders, for the corporation, and for employees. So why an ESOP? Well, especially now with baby boomers reaching the age when they're all starting to think about retirement, and like all of you, they are owners of closely held companies, and they're thinking, well, gee, what am I going to do with my business now? Maybe I want to sell part of it, maybe I want to sell all of it, maybe we have partners and one wants to sell and one doesn't. We need a way to provide liquidity here. And to be sure, there are other alternatives. You could try to find another company to buy your company. You maybe could have a few key employees buy your company. If you have a partner, maybe your partner could buy your company. But there are problems with all of these. You may not find that ideal buyer out there. Most companies don't, or if they find a buyer, it's packed with all sorts of unacceptable contingencies. That buyer, for instance, may want you gone, and maybe you'd like to kind of stay on, have some role. That buyer may absorb your employees, but fire some of your employees. You may not like that idea. You've worked hard to build your business. It has an identity that is associated with what you've worked hard to do, and now it becomes part of some other company. You don't know what's going to happen to your employees in this new context in terms of benefits and the way they're treated. Maybe you'd like to reward them for helping you build the business in the first place. So there could be problems with that. If somebody internally buys it, your partner or your employees, they have to use after-tax dollars to do that. That means if you want to sell $2 million in stock, they need to have probably well over $3 or $3.3 million in income in order to have that much money left over to $2 million to buy your stock, and they may not be able to do that. And even if they are, it's a very expensive way to do it given the tax cost. So it would be great if you could have some way that you could transfer business internally and do it on your own schedule and do it in a way that you could sell all of it or part of it. You can continue a role in the company if you like or not, on whatever basis you like. And you could get some tax benefits in the process. And that's really what an ESOP lets you do. It creates a way for owners of closely held companies to provide for ownership transition in a highly tax-favored manner. And I want to emphasize, this is not because of some loopholes in the law that clever lawyers discovered. This is because of explicit government policy to encourage it. It allows companies to be transferred to employees using corporate profits, not employees' after-tax dollars. And it's on a schedule that's comfortable to the owners. I want to emphasize this point just a little more, and we'll come back to it. But often when I start talking about ESOPs, whether it's to reporters or business people, and I explain how they work, and we go through the whole process, and I have already talked about this point. People say, okay, well, but what I don't get is when do the employees actually pay for the shares? And the answer is they don't pay for the shares ever. It is not funded by employees putting up their own money to buy the company. It is funded by future tax-deductible pre-tax earnings of the corporation. Now, think about this. Let's say that a leveraged buyout firm, a private equity firm, came and bought your company. How would they buy it? They would borrow money, and then they would buy your company, and they would repay that loan out of the future profits that your company generated. Indeed, if they didn't anticipate the ability to do that, there'd be no reason for them to buy the company in the first place. What ESOPs are doing is mimicking that same approach that Goldman Sachs might use or some private equity firm might use, but instead the benefit of that future pre-tax cash flow is going to the employees rather than some private equity firm. ESOPs can also be used just to attract, retain, reward, and motivate employees. They don't have to be used for business transition, and about a third aren't. Properly structured, and I'll come back to this a little bit if we have time, ESOPs can improve competitiveness. And I don't mean here the technical or legal structure of an ESOP. I mean the corporate culture that surrounds it, the degree to which employee ownership is combined with a high involvement culture with lots of work teams and open book management. We find, and research has repeatedly found, that those companies significantly outperform their rivals. And finally, we'll go into this in more detail. S corporations can avoid taxation on the profits attributable to the ESOP's ownership percentage. So if you have an S corporation that's 30% owned by an ESOP, 30% of your profits are not taxable. If you have 100% ESOP, and more ESOPs are, about 40% of them are, then the corporation pays no tax at all. So that's a nice benefit. So let's get some basics. First of all, ESOPs are a defined contribution plan under the Employee Retirement Income Security Act. That's the same law that governs 401k plans, for instance, and many of the rules for ESOPs are the same as for these other kinds of retirement plans. It's company sponsored and paid. As we said, employees very, very rarely buy shares, and particularly that's true in closely held companies. Almost never do they buy the shares. It's funded instead by company contributions to a trust. So think of your 401k plan. You've got a trust that holds the investments for employees, and ESOPs are like that. They have a trust as well, only this trust is specifically designed to invest in employer securities. So contributions are allocated among plan participants based on relative pay or a more level formula. And we can come back to some details on this. All full-time employees are usually covered by the plan, and this is subject to service and vesting rules. And then when employees are in the plan, they accumulate shares. That hopefully increases in value. When they leave the company, and only after they've left the company, then they can put those shares back to the company, and you can do that on some fairly flexible terms we'll discuss later. So you can see here that sometimes kids aren't always the most logical successor for a company, and as we discussed, people are looking for alternatives. So how does an ESOP actually work to buy out an owner? Well, step one is that you set up this employee benefit trust. Actually, a lawyer, of course, sets it up for you. And the company can fund this plan in two ways. The simple way is the company simply contributes cash to buy shares. So each year on a totally discretionary basis, the company says, we will put in X amount of dollars into the plan. The plan will take those dollars and turn around and it will buy Joe's ownership. If we've got $200,000 we put into the plan this year, it can buy $200,000 of Joe's shares this year. And you can continue to do that year after year until as many shares as you want are purchased. You could also decide that you want to contribute some shares to pre-fund, to contribute dollars to pre-fund a plan. You can do this for 2 or 3 years under the law. You can just put cash in, and the ESOP doesn't buy any shares at all with that cash, but it holds on to those dollars, and then it makes a larger purchase a few years down the road. So maybe that's a way to do some pre-planning for this if you're not quite ready to sell. More common way that an ESOP funds this is that the trust actually borrows money. So here's what happens. The trust goes to a bank, for instance, or it could be the seller. We'll talk a little bit more about seller financing as we go through this. But the basic principle we need to know now is that the ESOP is borrowing money from some other party. And let's say that Joe wants to sell $2 million worth of stock. So the ESOP borrows $2 million, takes the $2 million and buys Joe's $2 million in shares. But now the ESOP has to pay back the loan. Well, how does it do that? It does that because the company each year will put in a contribution into the ESOP to enable it to repay that loan. Now, to be very technical about this, there's actually typically 2 loans, one from the lender to the company, and the company reloans to the ESOP. And this provides some flexibility because the 2 loans don't have to have the same terms. So you might have a longer schedule for one loan than the other. That's sort of ESOP 201. So we won't go into that, but just know that you can do that. So the company puts these dollars into the plan to enable the ESOP to repay the loan, and Bob gets his $2 million up front that way rather than over time as in the cash contribution formula. The money that the company puts in to fund either approach, whether it's paying off the loan or the annual contributions, is entirely tax deductible. If you borrow money, you can deduct the interest, but you normally can't, in fact, never can deduct the principal, except if it's an ESOP. Then you can deduct the principal. Moreover, if you had a corporate redemption of your shares, so another way to deal with transition is simply to have the company use cash to buy your shares, but that redemption is not a deductible expense for the employer. So if you did a straight redemption for a $2 million purchase, the corporation would have to have about $3.5 million in income, in revenue, in order to have $2 million in profits to do it. With an ESOP, $2 million in contributions gets you $2 million in sale. There are some limits on how much you can put into the plan each year, 25% of the eligible pay, and eligible pay is defined as the pay of employees in the plan up to $245,000 a year per employee. But in reality, these contribution limits, at one time in the past they were lower and they were something of a constraint on some transactions, but there are many ways to do this now so that that really isn't a barrier for almost anybody. So borrowing money through the ESOP is the most common way to do this. And the mechanics of this is that the company contributes to the ESOP and it takes this tax deduction. So this $2 million in shares we just bought from Joe, that goes into what's called a suspense account. So this is the $2 million sits in this account, and each year as the loan gets repaid, if you paid 10% of the loan, for instance, in 2013, 10% of the shares get released from that account and allocated to accounts for individual employees. Now let's talk about one of the most common ways that this is funded. You can borrow the money through a bank, and about half the ESOPs are funded through a straight bank note, so that's fairly straightforward. But we're seeing more and more seller finance transactions now. So what happens here is that the seller takes a note from the ESOP, and the ESOP says we'll pay you off over X number of years at Y rate of interest. And so the seller gets, in effect, the upfront purchase price of the shares, $2 million in this case, but it's paid for over whatever period of time the note is for, and that's typically 5 to 10 years. Now, a lot of people are looking at seller financing now for a couple of reasons. One is that if you go to a bank and the bank makes the loan to the ESOP, the bank's probably going to want you as the seller to put up some kind of collateral to make sure that the loan gets repaid, either for all or part of the loan, depending on how much collateral the company can offer. So a lot of sellers are saying, well, if I'm at risk anyway, why don't I just make the loan? It will save us some legal costs of the loan transaction. It'll save us the hassle of going to banks. So that's one reason. The second reason is, and this is a particularly compelling one today, is that sellers are figuring, well, we're going to pay the bank whatever rate of interest this is, but an ESOP, because there's some risk in this loan, the seller can reasonably ask for typically 6 to 10% annual rates on this interest. And there's variation, and there are some fancy ways to structure this too, but it's pretty much in that range of 6 to 10%. And they think, well, gee, 6 to 10% a year for 5 to 10 years, I couldn't get that investing in pretty much anything else right now without taking, maybe I could go buy Greek bonds, but I don't want to take that level of risk. This looks like a pretty safe investment really for me. So not only do I get the 6 to 10% interest every year, but I've sold my stock at a favorable price with potential tax benefits. Now you can see on the slide that there's this tax deferral you can get on sales to an ESOP, and there are some constraints on how you can do that with seller financing. We can go into that if you like. It's a little bit complex, but just know that if you do seller financing, you can get this seller tax break, but it takes an additional step that we'll talk about. And then we've talked about the other two ways, the second way of financing a plan. The third way is in very limited circumstances, you can take money from an existing, typically a 401k plan, and move it into an ESOP. There are a variety of legal and fiduciary issues that come up here. It's a fairly expensive thing to do because of all the compliance issues. So you see it once in a while. Just know that it's something you could do, not something you typically see done. Well, this is great. So far we've got this highly tax-favored way to do this in pre-tax profits, and the employees don't have to pay. And we can do this in this very flexible way with a variety of financing options. But, the bottom line is, how much am I going to get for selling this business? And in an ESOP, the price must not be higher than a fair market value on a financial basis is determined by an independent outside appraisal firm. What does that mean? Well, you hire an outside appraiser, and he comes in or she comes in and says, if we've got Joe's business here, and let's say it's making $1 million a year in free cash flow, that's what they typically look at, how much would a theoretical investor be willing to pay to capture the right to that free cash flow? And so what they're looking at is how risky is this investment compared to other investments, and what rate of return do I want in order to justify that level of risk. You typically see in today's market anywhere from 3 to 7 times what's called EBITDA, earnings before interest, taxes, depreciation, and amortization. A lot of variation, of course, in this, and a lot of things that go into that calculation. So that's the real simple view of a more complex process. But that's what the appraiser is trying to figure out, is how much somebody who's going to buy your business as a standalone entity would be willing to pay for it. And that's the most that the ESOP can pay. If the ESOP is buying a less than controlling interest, there's going to be a discount because that buyer is going to pay less per share for a non-controlling interest than a controlling interest. Now, that generally is a pretty good price for the seller and a fair price, but there are some circumstances where you might have another company that says, gee, if we bought Joe's business, that EBITDA wouldn't be $1 million a year. It would be 1.5 because of synergies that the acquisition could bring either to them or to us. So Joe's business is worth more to us than it is as a standalone business, and therefore they're willing and can pay a higher synergistic price. And the ESOP can't pay that synergistic value. So if you're looking for the highest price and you've got a very good bid from a synergistic buyer, and price is your primary or sole concern, then the ESOP might not be the best approach. I would say for the typical closely held business that maybe 10% of the companies fall into that area where there is a synergistic buyer where the terms of the sale and contingencies attached to it really do make it more attractive than what an ESOP could offer. One other note here is that this price that is determined by the appraiser is the most that you can pay. You can pay less, but the seller can't negotiate once that price comes in with the ESOP and say, gee, you know, how about a bigger price? The appraiser said $20 per share, but I'm not willing to sell for less than $25. The ESOP simply can't pay more than $20. So you can see some of the elements of valuation here, and as I said, the primary element is free cash flow. They also do look at comparable company sale data. Again, they're not going to be looking at the synergistic sale data. And if you've got a lot of assets in your firm that are non-performing assets, you own a building, for instance, where you do your work, but you could sell that building and move someplace else and make a lot of money in the process, then that asset value will get added back into the total value. Now this section 1042, lawyers love to call things in terms of section codes, and you might hear this, but there is a particular benefit that's available to sellers that allows sellers to an ESOP to take a tax deferral on the gain that they've made from the sale of those shares of stock to their employees. So Joe sells his $2 million worth of stock to the ESOP, and normally that means that Joe's going to have to pay capital gains tax on whatever that is gain, and in most companies that's all of it. But with an ESOP, if you meet certain rules, you can defer that gain by reinvesting the $2 million in stocks and bonds of qualifying investments. And these are U.S. operating companies. So you're buying individual stocks and bonds of U.S. operating corporations. You don't buy real estate, you can't buy mutual funds, you can't buy T-bills or that sort of thing. So you could put all or part of that $2 million into these qualified replacement investments, and you don't pay any tax until you sell those investments, and then you'd pay capital gains starting with the basis of your shares in your company. If this goes into your estate, there's a step up in basis and no tax is ever due. There are some rules here. This only applies to C corporations. So if you're an S corporation, you'd need to convert to a C beforehand. That's easy to do. but there may be reasons you don't want to do it. But it's only for C corporations. Stock has to have been held for 3 years, and if you're a partnership or LLC or S and convert to C, it tracks that ownership for the 3 prior years. The ESOP has to own 30% of the shares after the transaction. And synthetic equity and so on, there are certain ways that they calculate that, but it's 30% of the fully diluted value of the company after the transaction. And then so that transaction that gets you to 30%, every subsequent transaction qualifies. And note that direct family members, sellers, and 25% owners can't get an allocation from the shares that go into the ESOP if they're still employees of the company. In other words, they can't sell, take a tax advantage, and then get the shares back anyway. Now, S corporations aren't allowed to get that tax deferral for the employer, but they do have some pretty neat advantages of their own. The most important of which, as I've noted, is the profits attributable to the ESOP are not subject to federal and almost always state income tax. Again, this seems like something that must be a loophole, but this is something Congress specifically intended. So a very common scenario you're seeing now is a seller finance transaction where the ESOP buys 100% of the company, and it now pays no taxes. The seller may retain some role in the company, may get a salary, may be on the board. The seller could even get something like stock appreciation rights or phantom stock as an additional equity because the seller can't get any shares back from the ESOP if they're still an employee. So there are ways that the seller can get a little extra equity in addition over time by continuing to work for the company. But this 100% ESOP pays no tax at all. So that's a huge cash flow advantage for the company. If it's a 30% ESOP, then 30% aren't taxed. Now, this last bullet point's important here, that distributions made to other owners must be made pro rata to the ESOP in an S corporation. In other words, in that 30% scenario, your 70% owner is probably going to say, you know what, I've got taxes on the profits attributable to my 70% ownership, so we need a distribution so I can pay them. Because in S corporations, they're pass-through entities. The corporation doesn't pay tax. The owners pay the tax. So these distributions are used to allow the owners to pay the tax. Well, S corporation law says if you make a distribution to the 70% owner, you've got to make a distribution to the 30% owner on a pro rata basis. So the ESOP gets these cash distributions, and they can be used to buy additional shares. In effect, you're using what would have been tax dollars to buy more shares from the seller. This becomes very unwieldy when you get to 50, 60% ownership because the distributions become so large. So you typically see S corporations either at about 30% or less ESOP or 100%. So a few key points to remember. The company, not the employees, fund the plan. The acquisition of shares is a non-productive expense, so the company must have the earnings to absorb it. In other words, if you're not profitable, it's going to be very difficult to find a way to do this. And ESOPs are the only way a company can use pre-tax dollars to buy out an owner. Now, there are some other applications as an additional employee benefit. So you can just contribute shares, and the value of the shares you contribute is deductible. You can acquire new capital with the shares. So the company can issue shares or sell treasury shares to an ESOP that borrows money to buy them. So the ESOP goes to a bank that say you want to make an acquisition or you want to buy a building. The ESOP borrows the cash to do that, buys newly issued company shares. Company takes the proceeds of the sale, makes the acquisition or buys the building, and now the ESOP ends up with ownership equal to the amount of that investment, but the company, in repaying the loan, can deduct the principal and the interest on that loan. So you can make that capital growth plan in pre-tax dollars rather than not being able to deduct the principal on the loan. We're also seeing a lot of established ESOPs being used to buy other companies, or in some cases where an ESOP is a division of a company, it's used to buy out the division. That's not an issue here. Now, before we go on to ownership approaches outside of the ESOP, I do want to just go over some of the basic rules here. And in the slides that you will get sent to you, I will send you links to a couple of articles that explain what I'm about to say in more detail, because it's the sort of thing that's a lot easier to have it in prose instead of bullet points. But if you understand how your 401k plan works, you're going to understand a lot of the rules for ESOPs on this. But let's remember that these shares now have gone into the plan, and the question becomes, well, how do employees get them? And what happens is that each year, the shares get allocated to employee accounts. And that allocation, as we put up in a slide earlier on, let's see if we can go back to that quickly. So all full-time employees now are put into the plan. So basically the rule says, just like 401k plans, that everybody who has worked for at least 1 year must be participant in the plan if they work more than 1,000 hours. Same rules for all retirement plans. So now the company's made a contribution to the ESOP, and I get an allocation of that. And that allocation will be based on, as the third bullet point there, it's going to be based on my relative pay of the compensation that's in the ESOP. So a simple example, I have $1 million in pay in the ESOP, and I make $50,000, and 5% of what gets allocated that year goes to me. Note here, you can't say this employee's had a great year, so they're going to get 12%, and this employee not such a good year, so they get 3%. You can't pick and choose. It's a formula. Everybody gets a percentage of the allocation based on their relative pay, or you could have a more level formula. You could say we're going to give points for seniority and points for pay, but the effect of that can't be that people who make over what's now in the law is $110,000 a year, they can't get more than what a straight pay formula would give them. So you can't have a system that discriminates in favor of more highly compensated employees, but you can have a system that discriminates in favor of less highly compensated. And again, this is exactly the same rule that applies to 401ks and pensions and so on. Like all those other plans, you can also have a vesting requirement. You can vest gradually over up to 6 years, or you can have cliff vesting over 3 years. So if I have $50,000 in my account and I'm 50% vested, I really only have $25,000 at that moment. Now, once the employee leaves, if they leave for death, retirement, disability, then they need to get a distribution of what's in their account a year after the end of the plan year after they leave. If they leave because they've terminated prior to that, then you can wait up to 6 years before starting to make those distributions. And in either case, you can make those distributions over up to 5 years in installments with interest. A couple other ESOP basics you should know about. The ESOP trust, remember all these things are trusts like all retirement plans, and they all have trustees. The ESOP has a trustee as well. It can be an outsider. It can be a CFO or a committee of employees. It shouldn't be the seller. And the trustee is responsible for plan governance. The trustee also votes the shares held in the plan, typically at the direction of the board, or you could provide that the employees direct the trustee as to the voting of the shares. About 85% of the ESOPs have the board tell the trustee how to vote the shares. What this means is governance is not really an issue. the board appoints the trustee elects the board. It's a circular arrangement, and if you're worried that an ESOP means the employees are going to run the company, that's only going to be true if you choose it to be that way. So those are some of the basics. As I said, they're very similar to other retirement plan rules, but they're actually a little more flexible in terms of payout, and they do have this governance wrinkle. So let's go back to ownership outside of the ESOP. What else can you do? Well, employees can purchase shares directly, either outside of the ESOP or even if you don't have an ESOP. One option is always for employees to buy the shares themselves. Let's say you've looked at this ESOP option and you say, no, I don't like it. It's not for me. I really want just these 5 people to own the company. What the most practical way to do that is for the seller to give those employees a note, and the employees are going to pay that out over some negotiated period of time. This is going to be all after-tax dollars to the employees, and it is going to be taxable as capital gains to the seller. Now, there are some various ways to help finance that, but ultimately, it's all going to pretty much come down to that. So it is possible. It's very difficult to do. Employees can also get additional equity outside of the ESOP. So you might look at the ESOP and say, you know, what I really don't like about this, Corey, is this notion that everybody gets allocated shares based on their relative pay. There's some people I want them to get more than that for whatever reason. And there are a variety of ways to do that. They can get conventional stock options, and you do that in a C corporation. In an S corporation ESOP, you typically don't want employees to own actual shares outside of the ESOP because it messes up the tax benefit of the S ESOP. And especially if you're 100% S ESOP, you don't want anybody else owning shares because you want that full tax benefit. So what we typically see in ESOPs, even in C corporations, is they use 2 very simple approaches. One is stock appreciation rights and the other is phantom stock. And one simply says, we're going to give you a cash bonus based on the increase in the value of our shares over some period of time, subject to vesting. And phantom stock says we're going to give you the actual value of the shares in cash over time, subject to vesting. So it's like a bonus that's denominated in terms of share value increase or share price. And again, ownership outside of the ESOP gets you no special tax treatment. There are some contribution limits. I put them up here. They really don't matter practically in almost every case, but if you want to know about those, they're on that slide. And here's more details, some bullet points on the participation, vesting, and allocation that we talked about earlier. Distribution rules, again, another slide here, and as I said, I'll send you a link that has this in prose. Paying for the distribution, well, the company's got to make sure that that happens. So it's the company that pays for the value of the shares. You might put the cash into the ESOP, so the ESOP can have the cash to do that, or it might be that the company buys them back with its own cash and either retires them or the shares can be put back into the ESOP later. We've talked about governance. Costs. For real small companies, this can be a barrier. And you can see what the costs here are on this slide. Their ESOPs are without a doubt more expensive than other kinds of plans. They're more expensive than a 401k plan, but they are far less expensive than selling a business other ways. If you sell a business, you're typically going to get a broker. The broker is going to charge a percentage of the transaction costs, plus you're going to have lawyers and accountants and everything else. So it is vastly less expensive to sell to an ESOP than to sell to another company or another investor in terms of transaction fees, but it is more expensive than to set up some other kind of retirement plan. We've talked about S corporations. I'm not going to go into this in detail. If you're interested in this, we can certainly talk about it, but the key takeaway here is that if you have an ESOP and an S corporation, you need at least 12 or 15 employees. You're going to run afoul of these rules, and that this fairly complicated second bullet here, the takeaway there is these laws were created so you didn't set up an ESOP as a 100% ESOP S corporation to benefit just a few people. Lawyers came up with all sorts of very clever and I think very unethical ideas on how you could sort of have pretend ESOPs where the employees at large would nominally get something, but all the value really went to just a few people in the company. And so Congress created some rules to prevent that. They are fairly complicated. If you have good intentions and you have more than 12 or 15 employees, it's easy to avoid them. We've talked here about selling directly to employees instead, and this looks at some of those issues. And if you have any questions, we can come back to that slide. So there are some additional slides here that I've included in here in case you're interested in these. I can certainly answer questions about them, but they're not really the focus of this presentation. But they do explain in more detail the individual equity arrangements that are available to provide equity to specific employees, whether you do an ESOP or not. And these are some of the types of things that are available and the rules for them. We have a lot of detailed information about these kinds of plans. If you go to our website at nceo.org, you will see that. Some additional resources that you can buy from us. We have publications on everything related to employee ownership, but for the topics that we've discussed today, the most useful, there's a book called The Decision Maker's Guide to Equity Compensation. That's more about individual equity compensation, stock options and the like. Selling your business to an ESOP, which is a detailed explanation of what we talked about today, and a broad discussion of ESOPs called Understanding ESOPs. So at nceo.org, you can go there and you can see how to get those publications. And that concludes my presentation, and I would be delighted to answer questions.
Okay. Corey, a couple that have been posed is, can employees get cash out of their account while they're still an employee?
You can set up a provision to allow them to do that, but you're not required to. It's not their choice, it's your choice about whether to structure the plan to make that possible.
Okay. Then I also had a question, does the selling price need to be fixed or can it be based on future profits? And I guess that gets into that whole appraisal thing that you talked about is, you know, that what would a rational, I guess, financial non-strategic buyer pay?
That's right. So fixed, I'm assuming that's a negotiated price, but it's always based, the valuation's pretty much always based on some multiple of future free cash flow.
Mm-hmm.
Now we have seen situations where an owner has said, well, that would give us $5 million, but I'll sell for $3 million. So you can do that, but fixed in the sense that you just pick some number and that's the number you use. You can't do that.
Okay. All right, those are the questions we had in chat and Q&A. We do have a number of folks who phoned in this time. I suspect they probably do have some questions they'd like to ask interactively. I'm going to now unmute the phones. I will ask all our participants on the phone, please don't put your line on hold. It'll make it real hard for everybody else to have a conversation. So all phone lines are now open. So I guess I'm going to go ahead and just ask one to clarify. So if I heard this right, you have to put every employee that meets that 1,000-hour rule into the ESOP.
That's right.
So if you're trying, because you know the majority of our folks answered your poll question said they're trying to do something for some key employees.
Yeah.
Sounds like you can't do that with an ESOP.
You can't. No, you can't just say this is just for these 6 people. Now, we did an analysis. Some managers at a company said, well, we'd like to buy our company. It had about 75 employees. And they said that 5 of them wanted to buy their company. And I said, well, you know, the conventional way you'd do that is you'd use after-tax dollars, your dollars, to buy the company. And then the company, once it became owned by you, its profits would be taxable. You could do 100% leveraged ESOP with the seller note from the owner. You would become participants in the ESOP, the 5 of you, based on your relative compensation. And you could get some stock appreciation rights on top of it. And so the way that would work, and then so we did an analysis of that. And we said, based on the numbers they gave us, it turned out that their compensation for those 5 people in this company represented about 15% of the total compensation. That's not unusual because they were the key people. And that they could reasonably get another 10 or 15% of the equity through this synthetic equity. So they ended up owning about 30% of the company. Plus, over time, other employees would leave and forfeit their shares because they weren't fully vested. Those unvested shares get reallocated to everybody who's still there, which would include them. So they'd end up with maybe a third of the company. But the company would pay no taxes, and they wouldn't have had to use pre-tax, after-tax dollars to buy the company. Wouldn't have cost them anything to buy the company. And it turned out, if you ran the numbers, that they were far better off owning a third of a 100% ESOP company than owning 100% of the company themselves. Because
that company's much, with all those tax benefits, you're 30% of a bigger number.
Yeah. So it's not intuitively obvious, but when people say, well, we just want this for key employees, you have to understand that if you do that, and you use that as a transition vehicle, you are costing people a great deal of money for that privilege. And unless you have a pretty big company with some very well-off employees, then A, it's probably not going to be practical, and B, it's probably not going to be to their benefit.
Yeah, that's a great point. Great point, Corey. Now, this 25% of eligible pay thing, so if an employee makes $80,000, that means up to $20,000 per year can go into the ESOP from the company profits. Did I hear that right?
Yeah, well, there are 2 different limits. One says that if you have $1 million in total payroll in the ESOP, the company can put in $250,000 a year into the ESOP. Each individual employee has there's a different calculation. These are the same for all retirement plans. And that calculation is that the employee can get up to an amount not greater than 100% of their pay added to their account each year, or $49,000, whichever is larger. So the 25% refers to your aggregate payroll. Then there's this individual limit. The individual limit is so high these days that it's a most unusual case where anybody worries about it.
Yeah, sounds like it. Now, if you pre-fund, are the dollars still tax deductible when the
Yes.
ESOP turns on?
Anything you put into the ESOP is deductible.
Okay. Okay, well, I'm done seating questions. Anybody else have any?
Corey, your NCEO is, you provide information. You are not a consulting company. How does a business owner vet out all those that are out there who might say they understand ESOPs? I mean, how could you be assured you have a company or a person that really truly does? Is there a way of doing that?
That's a good question. I wish there were as many ESOPs as consultants say they've set up, because there'd be 100,000, not 12. And if you go to a corporate attorney and you say, can you do an ESOP, they're going to say, sure. Or here's another real thing. You go to an accountant or an attorney or especially a business broker and you say, hey, how about an ESOP? If they don't know how to do it, there's a very high chance they'll tell you it's not a good idea. And there's an
not in their best interest.
Right. There's an extremely high chance, an extremely high chance if they're a broker that they will tell you it's not a good idea, because if a broker sells your business, they get typically 5 to 8% of the transaction. If a broker arranges a sale to an ESOP, they get nothing. There's no reason to have a broker involved in an ESOP transaction. You might pay them some hourly fee, but it would be improper to pay them a percentage of the transaction. It would be a violation. So they're going to tell you, no, it's not a good idea. And I've talked to brokers who've asked me about this, and they said, well, if that's the case, I'm not going to recommend it no matter how good it is. So you do need to find somebody who really knows what they're doing. We have a referral service, so if you're a member of the NCEO, and it costs $90 to join, so it's really cheap. There are a lot of benefits to that, but one of the benefits is that you can call us anytime you have questions and we can talk about consultants, but we also have a referral service of people who actually do this work on a regular basis. We're not endorsing them, but at least we know that this is something that they have experience with. What you then want to do is you're going to need a lawyer, an appraiser, and a plan administrator. Is talk to 3 of them each, find out what their fees are, find out if you like them, and ask for a client list. And if they won't give you a client list, don't use them. And then call some of those people and just find out what their experience has been. It's worth spending the time kicking those tires, because there are significant variations in fees and approaches, and you want somebody you're going to be comfortable with.
Corey,
but you can do it. I mean, there are plenty of people out there who do have experience.
Bob, looks like we do have some other questions that have come in. When I asked the one about the pay calculation, somebody put one in on chat that said, Fran said, do bonuses to employees count towards their relative pay calculation?
Yeah, you get to have some flexibility on this, but basically you're going to typically count all W-2 compensation. But you could exclude bonuses if you want to. But most often what companies do is say it's all W-2 compensation.
Okay. All right, another one is Richard asked is, what happens if the ESOP loan cannot be repaid from profits if, for example, the future ends up being full of losses?
Yeah, that's a very good question, and certainly it's been a more relevant question as of late. So you may have cash in the company, so there's no rule that says you have to have profits to make the payment. If you have cash in reserve, but you're losing money, you can still go ahead and pay off that loan. But what if you don't have either? You just can't pay it, can't make the payment. If it's a bank, you're going to try to go renegotiate the terms of the loan, just as you would with any other transaction. And if the bank says, sorry, we're just going to call the loan and we're going to claim whatever collateral's left, then you're like any other business. You're bankrupt, essentially, and the shares aren't worth anything. If it's a seller note, and if you've structured this properly, you've gotten good advice, there's a couple of options here. One is that the seller could just forgive the payment that year, and you do see that sometimes, where the seller says, we'll just forgive either the interest payment, the principal payment, or both. And in that case, it's counted as if you allocate, as if you made a contribution. So the shares, for whatever that amount is, get allocated. More often what you'd see happen is that the seller would extend the terms and say, okay, well, don't pay me this year. Let's hope next year is better.
Now, when that forgiveness happens, doesn't that create a taxable event for the party that benefited from the forgiveness?
Yes, it would if the party were taxable, but the ESOP isn't.
Ah, got it. Okay. All righty. I also have a question. Someone asked if you could briefly explain the phantom stock or stock appreciation once again.
These are really simple notions. And a stock appreciation right is like a stock option without the stock. So I could say to you, I'm going to give you the right to the value of 100 shares of our company. And let's say that those shares are worth $50 each. So I'm going to give you the right to $5,000 worth of stock today. But you're going to have to work here for 3 years in order to earn that. So at the end of 3 years, you're fully vested. And lo and behold, the $5,000 worth of stock is now worth $8,000. So the company would write you a check for $3,000. And it's treated the same way as if the company giving you a $3,000 bonus. You can have whatever terms you want on this. The vesting can be as long as you want, triggered by whatever you like. The term can be as long as you want. You could say, well, you're fully vested now in your $8,000 worth of stock appreciation rights, but you can choose to defer payment on it for up to another X number of years. And you have to make that choice at least a year in advance. Phantom stock's the same idea, except in this example, rather than getting the appreciation on the $5,000, you get the whole $5,000 plus whatever appreciation there is. So we would typically give an employee fewer phantom shares than we would stock appreciation rights because they have an innate value. And they are both taxed just as if you paid somebody a bonus, deductible to the corporation, taxable to the employee as wages.
Okay.
So a real simple way to do this. And we normally in closely held companies, I'm prone to recommend that as opposed to something that actually delivers shares. But there are circumstances where options or restricted stock make more sense.
Okay.
And we can do, by the way, on either this or ESOPs, we as I said, we're not consultants, but we can do very introductory overview type consulting for a couple hours to give people an idea. Here's what your alternatives are for employee ownership, pros and cons. We're not trying to sell you on one thing or another that we will do for some long-term relationship.
That's really nice to know that your organization does that, Corey, because there are, as business owners, myself included, we're bombarded by people selling what they've got.
Right.
Convinced that they all have the best magic wand that's going to satisfy all the owners' dreams and do something nice for the employees too.
Yeah, there's no magic, and there's no magic with these things either. It fits some companies perfectly and other companies not so well.
Well, I don't see any other questions posed in the panel, and we are reaching the end of our time, but one last call for any questions from our attendees. Otherwise, I think let's go ahead and wrap things up. On the phone or everything they want to pose? Okay, well, I'm going to switch things back and get you the closing slide up so you can wrap up, Bob.
Okay. Well, to all of the attendees, I want to thank you for your participation. There were a lot of really good questions today. and that obviously is an indication of strong interest. So my hope is that you have several takeaways that will enable you to better plan ownership transition. And Corey, thank you for the contribution of your time and expertise. Your presentation was very insightful, and we wish the best for you and continued success at NCEO.
Thank you.
Oh, you're quite welcome. And thanks again to our host and sponsor, Software Toolbox, and John Weber's skills at navigating webinars. And you had lots of very good questions today to continue the conversation. So anyway, be sure to complete the survey for today's webinar. It'll arrive in your inbox within about an hour, and takes only about 30 seconds to complete. So we really need your feedback so that we can continue to make our monthly webinars better. So in closing, just a few things to keep in mind regarding CSIA. Best Practices Committee is continuing to request that our members contribute templates for the roadmap to certification. So as they identify different parts of best practices for which templates are being requested, please give consideration to sharing your expertise with other members. Also, be sure to implement CSIA best practices and eventually work towards CSIA certification if you are not yet a certified member. And I encourage you to participate in the CSIA statistics program. It's where you can benchmark yourself against your peers, and there's really no other program like it. And there's a salary survey that's going to be coming out very soon as part of the statistics program, and I would encourage you to participate in that as well. And it covers much more than just the technical people in your company. So it's a good program, and it's not at all costly. And finally, if you have a suggested topic for a future webinar, include those ideas in your survey comments. So again, this is Bob Lowe, the Executive Director, and thanks again for attending. Goodbye.